Welcome to this review of Module 7 of the Derivatives Masterclass. This module was all on foreign exchange. Now remember that foreign exchange can be confusing, so it's quite important that you thoroughly review the FX basics. That means terminology, jargon, forward price calculation, etc. Apart from that, we covered three main themes. First, foreign investments. You need to understand how the return of a foreign investment is driven by the foreign asset return and the currency return. And especially important, you need to understand how FX hedging impacts your return. Then we turned our attention to FX options. We saw that there are different ways to quote an FX option. You need to be able to convert between the different prices. And finally, we saw in this module that an FX option can be replicated dynamically as a position in the base currency and a position in the quote currency. We called this the big truth because it showed us that every option has in fact two deltas, not just in FX. But one step at a time. First, foreign investments. Here we just do an example. Let's assume we have a 1 year period, and over this 1 year period, the Swiss franc interest rates are minus 75 basis points, the US dollar interest rate is 1%, the US dollar weakens against the Swiss franc by 7%, and the S&P 500 had a total return of 10%. Assume that we have a Swiss franc investor, and the Swiss franc investor invests in the S&P 500. Now the natural questions: how much is the overall return that the Swiss franc investor earns? How much of that overall return is due to equity performance and how much is due to FX performance? And then how does this performance change, or how would his performance change if he hedged the FX risk away in total or just partially? Now, if we think about that, overall, one thing is clear. What the Swiss franc investor gets is two things. So his total return is driven by the FX movements and by the total return of the S&P. So in our case, the S&P makes 10%, but on the other hand, every dollar loses 7%. So in total, the Swiss investor would get the 10% equity performance, and he would get the minus 7% FX performance. So in total, he would have a return of 3%. Now it turns out that this split in the 10% and the 7% is not very useful when we want to think about the impact of FX hedging. So therefore, let's lean back and let's think again about this investment. Especially, we could think about what is actually the Swiss franc investor entitled to earn. What does he do? Now, first and foremost, the Swiss franc investor is investing Swiss francs. So he is investing Swiss franc capital. Therefore, he should at least earn the Swiss franc interest rates. Or say it that way, if he would invest in Swiss francs without taking any risk, he would just earn the Swiss franc interest rates. But our investor takes two kinds of risks. First, he takes FX risk because he invests in a US dollar investment. Now, we could say, okay, what is the basic driver of this FX risk? That means how much return does pure US dollar FX risk generate? Now, to answer this, we could think about, okay, what is the minimum risk investment in the US dollar land? And this is, of course, a US dollar money market fund. So we could calculate the excess return that a Swiss investor gets for investing in a US dollar money market fund. Excess return, I mean in excess of Swiss francs interest rates. Now, this is how much he earns, positive or negative, because he takes FX risk. And then on top, our investor also takes equity risk. He invests in the S&P 500. So we could say we could ask ourselves, what is the excess return that is generated, positive return or negative return, because you invest into the S&P 500? Here I call this just a foreign asset class. Now let's calculate the numbers here. The base rate, the Swiss franc interest rate, is minus 75 basis points. This is here a bit confusing because it's a negative interest rate. What is the excess return? The return in excess of the Swiss franc cash rate if you invest in a US dollar money market fund. So if a Swiss investor invests in a US dollar money market fund, he would earn the US dollar interest rates. He would get the US dollar Swiss FX returns. So in our case, this is 1% is the US dollar interest rate. The FX performance is minus 7%. This would be minus 6%, but then in excess of the minus 75 basis points. So this is minus 5.25%. So the FX risk generated over this year an excess return of minus 5.25%. We had a loss of 5.25% because we took the FX risk. Now the S&P risk premium, or let's say the S&P excess return. Excess return is again the return in excess to the base rate. Here we are already in the US dollar space, so we take as a base rate the US dollar interest rate. So what is the excess return of the S&P investment in excess of the US dollar money market rate? And we see that the total return of the S&P is 10%. The US dollar interest rate is 1%. So the excess return is 9%. If we now add that together, you guess what we get? We get the same as before. The total performance is the minus 75 basis points Swiss franc interest rate. So we get that for committing the capital. For taking the FX risk over this 1 year period, we had a negative and excess return of minus 5.25%. And for taking the S&P return, we had a very nice positive return of 9%. If we add it together, we get here minus 6% plus 9% is 3%. So this is the same. So you ask, okay, what is the advantage? The advantage is now that we have thoroughly separated the return in the three buckets: capital, FX risk, and equity risk. With this decomposition, hedging a risk only affects that return that was due to that risk. So if we start hedging the FX risk away, it will only affect the minus 5.25%. If we start hedging equity risk away, it will affect the 9%. So if we totally hedge the FX risk away, all the minus 5.25% goes away. So the hedged performance of our Swiss investor, the FX hedged performance, would be still the minus 75 basis points for committing the capital, and the 9% excess S&P return. so he would get minus 75 basis points plus 9%, which is 8.25%. Now, what is interesting here and very important to realize is that the US investor and the FX hedged Swiss investor do not earn the same return. Namely, the US investor, we saw if he invests in an S&P 500 portfolio, he would earn 10%, and the Swiss franc investor would only earn 8.25%. But the US investor and the FX hedged Swiss investor, they have the same excess return. The return in excess of their cash, and therefore they also have the same Sharpe ratio. So if we check that, the US dollar investor gets 10%, but his interest rate is 1%, so the excess return he makes is 9%. Similarly, the Swiss investor, he earns 8.25%, but his base return, his Swiss franc return, is minus 75 basis points. So he has a return over this Swiss franc rate of 9% as well. If we now just partially hedge, so let's say we hedge a third of the FX risk away, then logically we only get 2/3 of the return that is due to taking FX risk. And if I calculate that, 2/3 of 5.25% is about minus 3.5%. So the total return the partially hedged Swiss franc investor gets is still the 75 basis points Swiss franc interest rates plus the partially hedged FX excess return. That means 2/3 of the negative FX excess return plus the 9% equity return. And if you calculate that together, you get 4.75%. Let's now move to FX options. We have the currency pair euro-pound. The spot rate is 0.9. The option is the right to sell 1 million euros for £880,000 in 6 months. The price of the option is given as a percentage of the pound face. Additionally, we have the euro delta of the option. Now the questions. First, please convert this price into pound pips. Second, what is the pound delta of the option? Now let's first deal with question 1. How do I convert an option premium into another form? Now this is actually quite easy, but in general what is usually good to do to always remember that since FX is more symmetric, we can be confused whether an option is a call or a put. And of course, every option is a call and a put, and this gets very obvious in FX. So this option is the right to sell 1 million euros and to receive £880,000 for it. So if you exercise your right, you will give away euros and you receive pounds. So you can think of this option either as a put on the euro with a notional of 1 million euros. So then the underlying is 1 million euros and the strike price is £880,000. The natural way probably to look at that is a put on the currency pair euro-pound. The currency pair euro-pound, the spot rate is 0.9. The option then would have a strike of 0.88. So the option would be a put and the option is out of the money. The notional, or the multiplier if you want so, is 1 million euros. Or you can think of this option as a call on the pound. The notional, the pound notional, is 880,000. If you look at the option this way, then the underlying would be £880,000 and the strike price 1 million euros. Or if you think as on a notional of £1, you have the currency pair pound euro. That's not how it's usually quoted, but you could quote it like that, which is at the moment 1.1111. The strike price would be 1.1364. This option is now a call on the currency pair. The option is out of the money. Now that we have reviewed this duality between calls and puts, let's now convert the premium. The premium here is given as a percentage of the pound face, and the question was to convert this price in pound pips. So first you have to remember, what are pound pips? The price expressed in pound pips is the price per €1 notional expressed in pounds, more precisely expressed in pound pips. So what do? First, we calculate the total price. The total price is £10,512.48, but this is the price per €1 million notional. So we have to shrink it down to €1 notional. And if you do that, you just divide this price by 1 million, you get a price of 0.01051248 pounds, which is 105.12 pound pips. So that was straightforward. We could, of course, do the same in euro pips. Expressing the price in euro pips would be the price per £1 notional expressed in euros, better in euro pips. So the total price in pounds was 10,512.48. If I convert this into euros, of course, at the spot rate, I would get a euro price of 11,680.53. But this is the price per notional £880,000. I need a notional of £1, so I need to divide this price by 880,000, and I get then a euro price of 0.013273 euros, which is nothing else than 132.73 euro pips. Or I could express the price in percentage of the euro face. So that's also quite easy. I calculate the total price again. The total price again in euros is 11,680. That's for a euro notional of 1 million. So I divide this by 1 million and I get a percentage price, a euro percentage price of 1.1681% of the euro face. So that was quite straightforward. Let's turn our attention now to the second question. The second question was, what is the pound delta of the option? We have given the euro delta. What is the pound delta? Now, how do I get this number out? Let me first go back to what I called before the big truth, namely the fact that every option has two deltas. This can be shown quite nicely with the Black-Scholes formula. So here the Black-Scholes formula for a call option. If we interpret our FX option as a call option, then the underlying is £880,000 and the strike price is 1 million euros. So you could say the spot price is the current price of the underlying of the £880,000 and X is 1 million euros. Also, I can write this equation a little bit nicer by remarking that the carry rate is actually the euro rate minus the pound rate, and the interest rates or the money market rate would in this case be the euro rate. So if I fill this in, the formula simplifies here to the first discount rate is just the pound rate, and the second discount rate is the euro rate. But for our purposes, this is not too important. But what is important now is that I can interpret this equation as an equation between positions. So let's do that. If I think of positions, then this would be our option, the C. What would be S? S would be the spot price of the £880,000, but I can express this in pounds or euros. If I express it in pounds, it's just £880,000. The X is just 1 billion euros. So if I write the equation like that, I can now see that I have one part that is an amount in pounds and one part that is an amount in euros. So I can write the option as a position in pounds and a position in euros. And that's what we call the pound delta and the euro delta. And if we have written it like that, then the solution to the problem we want to solve is quite simple. What do we have? We have given the euro delta. The euro delta is 339,711. Actually, it's a negative amount because this is a euro put. We also have the value. The value of the option is £10,512. So what I need to do, I just need to solve for the pound delta. In order to do that, I convert everything into pounds and solve for the pound delta. I have done it here. The pound delta is nothing else than the value in pounds, and then I take this part on the other side minus the euro delta, but the euro delta converted into pounds, and if I calculate that, I get a pound delta of 316,252. So this is quite nice. The option behaves right now. This is the dynamic replication. It behaves right now as a position in pounds, namely 316,252 pounds, and a short position in euros, namely minus 339,711 euros. So I have two deltas. Which one do I use for hedging? Well, that depends who you are. If you are a trader and you want to preserve the value of your book, it depends in which currency your P&L is. If your P&L is in euros, then the pound delta is your risk, and you would hedge your position by selling the pound delta. That means your hedge order would be to sell 316,252 pounds in the spot market. On the other hand, if you're an FX trader in London and say your book would have a P&L in pounds, then the euro delta is your risk, and you would hedge by buying 339,711 euros in the spot market. Actually, that's quite nice, isn't it? Well, this was mainly what we talked about in Module 7. There was one additional thing which was important and interesting. We talked about barrier options and corporate hedging, but this is not a focus on the test.